Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. You have investments? You ever wonder how your investments are doing relative to other investments out there? Well, I'm going to share with you how you can figure that out real quick and easy without going through all the litany of different things that investment professionals will throw at you as a way to justify their fees. It's going to be so simple and so easy to do. And the best thing about it is you can invest in the strategy without having to do anything. So what happens? Investment managers will charge a fee. That fee is premised on the idea that they can do something for you, or else they wouldn't charge the fee. And a lot of times it's they can beat the market. I highly challenge that to any, and you should too. But then they're going to say, well, we are beating the market. And if you look at the benchmark we're using, we're beating it. And the first thing that should come into your mind is, well, what exactly is that benchmark? And what I found is in my over 20 years in this business is the benchmark can be as convoluted as you could possibly imagine. And it used to be the benchmark would just be the S&P 500. That wasn't enough. So then it'd be the S&P 500 with the Russell 2000. We'd have the total bond index in there, the Barclays aggregate bond index, and maybe the MSCI EFA for international. Those four indices, S&P 500, Russell 2000, MSCI EFA, and then the Barclays total bond aggregate. And that was fine because then you say at the end of the day, I have these four benchmarks, these four indices, and I know my portfolio is competing against all four because I have, I hope, a diversified portfolio that has a little bit of bonds, a little bit of large company stocks, a little bit of small company stocks, and a little bit international. And how your portfolio did relative to those four indices would be how much you had in any of those four sections. If you had a lot of bonds when the bond market was getting killed, you probably underperform. Well, that's fine. And vice versa, if you had a lot of stocks or growth stocks or large cap stocks when the S&P 500 is doing well, you probably outperform the benchmark. There's nothing wrong with that. At the end of the day, though, even with those four indices, you couldn't invest directly in those four indices. Yes, you could buy an index fund that tracks the indices, but no index fund is going to have 100% tracking. And what that they call is a tracking error. There's always going to be a little bit of divergence between the actual index and the actual index fund itself. It just makes sense. The S&P 500 investment committee gets together and they say, we're going to get rid of Circuit City and we're going to bring on Amazon. Well, they're going to do that, and then they're going to let people know. And so when they let people know that they've done that, Vanguard, S&P 500 or whatnot, well, it's going to be they're going to be trailing a little bit. Now they'll go, algorithms will go in there and act accordingly, but there's always going to be a little bit of a lag between when the S&P 500 investment committee and the actual performance, the actual execution of the trades through the S&P 500 index. And that's called a tracking error. And I'll give you another example. If you're using a total stock market index, there's actually 5,000 stocks in the VTSMX. That's the Vanguard Total Stock Market Index. Well, guess what? There's more than 9,000 publicly traded stocks in the United States right now. So that's going to have a little bit bigger tracking error simply because there's more actively traded stocks than are in the index itself. But that's going to be pretty small potatoes at the end of the day. At least you know for a fact, if you don't like how your investments are performing relative to a benchmark, you can then go and invest in that benchmark via an index fund. Can't do that with a lot of benchmarks these guys use today. I'm telling you, I see in my last firm, we use those four major indices. Again, the S&P 500, Russell 2000, MSCI EFA, and then we use a Barclays total aggregate bond index. Now it's all convoluted. They're using 13.2% in here, 12.2% over there, 28.1% there. And no one knows what it means. No one can invest in it directly. It's all theoretical, but they're using that as a way to justify their expenses in terms of their performance. They're saying at the end of the day, we're beating the benchmark. Hey, well, what is the benchmark? Well, can I invest in it? Yeah, that doesn't do anyone any good. It's all convoluted as a way to make the investment managers seem like they're doing better than they are. I can't guarantee this, but I guarantee someone should do a study. Harvard Business School, HBS, if you're watching this, do a study, ask how many investment managers actually beat their benchmark that they provide to their clients on their end of the year performance reports. I bet you see the majority of them do, if not the vast majority. And you're going to say, well, how can that be when we hear all the time the active managers underperform the benchmark? Well, because the benchmark that we're talking about, the active managers who are underperforming are the basic indices like we just talked about. The active managers concocting their own benchmarks, so it's going to be a whole lot easier to outperform that when they You get to concoct the benchmark. It's kind of like Stalin. Stalin said, hey, I'm glad everybody voted, but I control the votes. I'm the one who counts the votes. So, okay, good job voting. But at the end of the day, your vote doesn't matter, as I'm the only person that matters is the person who counts the votes. And as evil as that guy was, there was some truth to that. If I count the votes, and the same thing here. If I'm the investment manager and my fees are contingent on you staying happy with your performance, and I get to tell you what to compare my performance to, I'm going to compare my performance to the Cleveland Browns every year. I'm not saying it's that bad, but you get the gist. However, there's a better way to do this. And I'm going to show you here. We're just going to use a Vanguard fund. And we're going to say at the end of the day, if I want to compare you, Mr. Investment Manager, to an indices or a benchmark that I could readily invest in, i.e., I don't like how you're performing, thus I want to invest in over here, what would be that strategy? And it's actually quite simple. Vanguard has these things called the Life Strategy Funds. And this one's called the Vanguard Life Strategy Growth Fund. And because it has a ticker, that means you can invest in it directly, my friends. 5-letter tickers for mutual funds, 3 and 4 are for stocks. Typically, a 4-letter stock will be on the NASDAQ, a 3-letter stock or lower will be on the NYSE. Not every time, but generally speaking, that's the case. A 5-letter ticker will mean it's a mutual fund. So in this case, VASGX. It's a wonderful benchmarking tool you should use. Let me show you what it is. It's Vanguard Life Strategy Growth Fund. Let me show you what it does. It's got 78% stocks, 20% in bonds, and about 2% in cash. So basically 80-20 roughly, an 80-20 portfolio, which is an aggressive growth portfolio for sure. Not 100% aggressive. It does have some bonds in there, but still at the end of the day, it's the vast majority amount of stocks. Now you might say, what does it have in this fund? This is it. These 4 indices. That's it. Total stock market index, total international stock index, total bond market index, total international bond index. That's it. 47% in the total stock market, which is domestic stocks, of which 70 to 75% of that is the S&P 500. So large domestic stocks predominantly. 32% international stocks. Off the top of my head, I can't remember how it's broken down. We'll show you here in a second. 14% in the U.S. bond market index. About 70% of that will be in treasuries, government bonds, and 6% in international bonds. Could not be any simpler than that, my friend. So 80-20 with 4 portfolios of index funds, and that's it. Cannot be any simpler than that, which is why it's a wonderful mechanism for benchmarking against your own investments. Because all that matters is, I put $100,000 in today, or last year, it is worth what today? You put $100,000 in your managed portfolio last year is worth what today? That's it. At the end of the day, the performance numbers of this will be net of all fees. And one thing I also want to make sure you understand is when you're looking at professional money managers who are charging you a fee, the doggone better be at the end of the net of fees of the returns they're giving you. Gross of fees is completely irrelevant. And I know companies that do that. It ticks me off. It's net of fees. That's all that matters, because I can only take out my money net of fees. You might have been able to be the next Warren Buffett, but if you're charging me 10% a year, it doesn't mean anything. It doesn't mean anything. I can't take that money gross of fees and spend it. I can only take the money net of fees. And so let's just see. So what I like, this is Yahoo. They give us a nice little breakdown of maturity of the bonds, the government bond ratings, and it's a nice thing. And you can look at this. I just like this because it gives us a mechanism we can easily analyze our own investments relative to this fund that we can invest in if we want. We'll just go over real quick. This Vanguard's a fund family. It's got $14.5 billion in assets, so that's not going away anytime soon. It's been around since 1994, so it's got some track record, almost 25 years. And here's what I like about it. The funds, the expenses are 0.14 is what it charges you. So it's incredibly cheap to own. There's no commissions, there's no nothing. It gives us the expense ratios in terms of dollar amount going forward. So I'm a big fan. Let's see, in terms of portfolio, we already looked at that. There's a lot of stuff that you can look at with this fund just to make sure it's tracking what you want. From my perspective, it's absolutely diversified enough to give you a good benchmark for sure. A little bit more on the large cap stocks, maybe a little bit more so on domestic than I would personally like, but it's a great way to benchmark your investments. And all you want to say is, at the end of the day, Did this fund do better than your fund net of fees? That's it. That's what you want to find out. If you want more detail, you go over here to Morningstar, and Morningstar will give you, enough detail. I mean, my goodness, you got 4-star rating from Morningstar, and that's good. I said in other videos and blog posts why you should highly rated funds. It's just more stability, consistency, and low fees without question. So the Morningstar higher rated funds have a reason to invest. A little bit outperformance, not much, but a little bit enough. You're still outperforming, but it's more so for consistency and stability and low fees is why you really want to invest in Morningstar higher rated funds. Fee level low. Again, there's an expense ratio of 0.14. Morningstar will give you a little bit in terms of more of its the portfolio construction. And Frank, I don't really care that much, but we'll see about it here. Hit portfolio. So let's just say you're a relatively aggressive investor, and you're hiring some guy, and you're like, man, he gives me some benchmark. I don't know if it's good or bad. So what you'd want to do is you want to say, give me a list of my returns from year over year over year. That's all I care about. And let's compare it to this thing right here, a Vanguard Life Strategy Growth Fund, which is 80% stocks, 20% bonds, and the net fees are 0.14. It's incredibly cheap. What these performance numbers are going to show me too, by the way, is after the fees. All right. So again, we want to look at net to net, not net to gross. That's not fair. So look, the Morningstar will break it down to market cap size. And what you see here is mostly large cap. That's the only drawback about this is it definitely does not have a significant exposure to small, but it really has got 23 to 24% exposure of its stocks to small and mid. I'd like a little bit more on the small side, but I mean, it's still exposure to there. It's not just the S&P 500, that's for sure. And that's I like that quite a bit, actually. It'll give you the breakdown of the different sectors that it has, the country allocations. U.S. is 65%, Japan 7%, France, and you can see all that. So it gives you a nice little breakdown of stuff. Bond maturities, world regions. I mean, you can see the whole thing. Europe developed, plus the UK is 15%, Japan, Australia, Asia. It's just so it's diverse. I mean, it's what we're looking for. We're looking for a diverse, keep it simple portfolio that we can use to weigh our own performance relative to something I could buy instead. So let's just look at, I did this here. And again, I want to do $100,000 invested, what it's worth at the end of a certain amount of time. So here's VASDGX. Here's a small cap Russell 2000, the S&P 500. All right, so on this fund right here, $100,000 invested at 31 December 1999, and you can see it would have dropped there, gone back up, and so you can see we had 5 down years, 6 down years, and what's that? Roughly 18 years. So a third of the time is negative. I mean, that's to be expected. In fact, absolutely is to be expected. A third of the time had a negative return. So in any given calendar year, 33% of the time it was down. If you can't fathom that, you are in the wrong fund. That's just all there is to it. But $100,000 invested is worth $244,000 at the end of 2017. Now, if we want to just look at the S&P 500, $100,000 invested was worth $250,000 at the end of 2017. All right. Now, again, is that good or bad? Well, I don't know. I mean, it is what it is. So we've over those 17 years, we've averaged, we've gone up from, doubled in a half. Was that doubled in a half? I don't know what that terminology is, but we've increased our portfolio by 150%. That's not too shabby for sure, given what we've gone through the last 15 years. But just remember, at the end of the day, all I want to know for you as you're analyzing your own portfolio relative to whatever benchmark you're using is if you're going to use this, you should say, Mr. and Mrs. Investment Money Manager, I gave you $100,000. What happened the next year? I gave you $100,000. What happened in 2013? What happened in 2014? That's all that matters. Nothing else matters, because this is a way you can evaluate your returns versus your money manager. And I hate to say it, if your money manager is at 7.5 net of fees, again, he was at 16.4 net of fees. Here he's down 4% net of fees. Here he's up 3%. I mean, you switch out to this. I mean, there's just no way getting around that. Now, what I want to show you, and this is the last thing we'll share with you, this is a small cap index that Vanguard has, the Russell 2000. So I want to show you something. 100,000 here in the Russell 2000. See, we had one down here, 2, 3, 4, 5. They've only had 5 down years over the 18 years, so about 28% or so. But watch this. Now, we're using this as our benchmark because it's diversified, again, a little bit more on the large cap side and a little bit less on the international side, but still it's diversified without question, and it has some bonds in there. Now, watch the difference, though, if we just use all small cap stocks. $100,000 invested in all small cap stocks would have been worth $437,000. That's $200,000 more than our diversified portfolio over here. So why do I point that out? Should that mean you should invest in small cap? Nope. That means it's not diversified. If it has that much divergence over a nice diversified portfolio, keep it simple, stupid portfolio, that means there's something there that's not diverse enough in order to hold it back when the markets are doing well in the area. So what happens with a diversified portfolio is you're always going to have to say you're sorry because something's going to underperform, be it emerging markets for basically other than these last couple of years. Emerging markets just got hammered. International stocks just got hammered. A couple of years, bonds got hammered. All right. So, you're always going to have to underperform something in a diversified portfolio, which is why I love it for a benchmark, because you're always going to have to say you're sorry. Now, people in hindsight say, oh, man, I should have been the small caps. Yep, you should have been. But guess what? During 2016, from 2015 to 2016, this was down about 30% at one point. Now, you don't see it here, but it got hammered. This was not down 30%. This was deep in bear market territory in about a 6-month time frame. This was not. So you're trading for this diversification. You're potentially trading upside growth for a lot less volatility. Now, in the midst of the chaos of 2016, no one in there was saying, oh, the small caps are going to come back around and do great. Everyone was nervous Nellies because that's what happens when you're not diversified. Now, I'm not saying don't buy this. I don't care. What I am saying is at the end of the day, if a nice diversified portfolio like this, like the Vanguard Life Cycle Growth Fund, is doing X and your investments are doing significantly differently, that means there's something in there that's not diversified. They're taking a lot more risk, or they're taking a lot less risk. I don't know what it is. But you should be tracking pretty doggone close. And if you're not, that means they're doing something differently that you just need to be aware of. That does not mean it's wrong. But if you were to come to me and say, oh, man, your portfolio is only up $244,000, that's nothing. Mine's up $437,000. I'm up $200,000 more than you. My first thing is saying you don't have a diverse portfolio. It's impossible to have a diverse portfolio if you have that much outperformance. You just don't. And if you don't want a diverse portfolio, that's fine. But if you think you're going into an investment and you think it's diverse, and this is what happens in that result, no, you're wrong. Something could go horribly wrong if that section of the investment market takes it on the chin. So I just want to point that out. So again, real quick, at the end of the day, this is the S&P 500, 100% U.S. domestic stocks. That's it. A little bit growth tilt. There's only up no bonds, no international, no nothing. And yet $100,000 invested in that was only grew to $250,000. Here's a diversified portfolio of bonds, about 20%. International, again, still a growth tilt on the S&P 500, but it even has small caps, and that underperformed as well. But it's more diversified, and that's what you want. Of the 3 portfolios, this is the one you want to benchmark because it's diversified across many different indices: large cap, small cap, bonds, international, emerging markets. So I hope that's helpful. So anytime you're looking at funds and you're saying to the investment manager, oh, we did this against the benchmark, say, well, how did you do against the Vanguard Life Strategy Growth Fund or the Vanguard Life Strategy Income Fund or whatever it is? They have a bunch of different life strategy funds for who you are as an investor. And they'll say, oh, I'm not sure. I said, well, give me the year-over-year returns. Let's see. And if the year-over-year returns are significantly different than this, you just need to know that means they're not investing similar as you are in terms of diversification. And that may be adequate for you. I don't know. But if you think you're diversified and their numbers are significantly off this, you're not. Now, lastly, if they're way underperforming, then you need to get out. There's just no other way around that, because then you're leaving money. They're taking money from you as a fee, which could go back to your own portfolio right here. And I know firms that do that. Trust me, I know there are firms that way underperform net of fees. And at the end of the day, there's just no justification with keeping at it. It's just not. if they're diversified and they're giving you some crazy diversified benchmark, and when you just keep it simple and look at the Vanguard Life Strategy benchmarks and they're way underperforming, get out of there, and just go buy a Vanguard fund. You'll be better off for it. You'll save money, and you're probably going to do much better in the long run. All right. Hope this helps, guys. This is just a way to how to benchmark your own investments. Have questions, thoughts, concerns, put it in the comments down below. Don't forget to give me a thumbs up. That always helps YouTube spread the word about the Heritage Wealth Planning YouTube channel. Don't forget to go to heritagewealthplanning.com for the blog that I have, my podcast, my blog, and the other content on there as well. And then, of course, don't forget to subscribe. Hit subscribe down below for future content. And we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.